Good afternoon. The first 6 months of 2002 is in the books, and I thought I'd share a video with you and let's talk about it a little bit. This is one of our first videos that we're doing. We've had a lot of requests, and hopefully, if this is successful, we'll do quite a few more. 2002, the first 6 months, has been the worst since 1970. The worst performance in the stock market since 1970. That goes back a long time, 52 years. Some of the reasons are inflation. We've all heard of inflation. If you put gas in your car, we know that there's an oil issue. There's quite a bit of costs in there. We have the Russian war with Ukraine that we have to deal with. And we also have the Federal Reserve raising interest rates. So these are all headwinds to the market and what has caused some of the decline. In addition, the Michigan Consumer Sentiment Survey is at an all-time low, so people are not feeling good. Now, let's pay attention to what people are actually doing. So they may not feel good, but they're still out there spending. They're still out there working. People are hiring, and there's a lot of economic activity still going on. So even though there's a lot of fear and concern out there, it's not really showing up in people's behavior. The stock market tends to be a leading indicator. When I do get phone calls and people are worried about what if we go into a recession. Well, I believe we're probably in a recession right now, and the markets tend to price that in. So most of the bad news, the energy, the war, the recessions, and so on, is already priced into the stock market for the most part. So what do we do from here? Well, our portfolios have been doing reasonably well in comparison. The S&P 500 is down 21% for the year. The NASDAQ, technology, and so on is down 30%. More surprisingly, the 30-year bond is down 20%. So what that says is there really hasn't been anywhere to hide, nowhere to go, except for cash. We did raise quite a bit of cash towards the end of the year, and so that's helped a lot. Our portfolios are down, but they're down probably half of the stock market in general. You may know that I always say that I don't want to lose more than I can easily recover. We're still at a point where we can recover that, assuming the economy picks up, the stock market picks up, we can easily recover that by the end of the year. Now, what would help recover? What would make the market go back up? Well, certainly an end to the war in Ukraine. Some indication that the Federal Reserve is pulling back on their hiking spree. Price of oil going down. And that's actually happened a little bit this week. So we did see a drop in gas prices, but we need to see more of that. And perhaps some numbers that show that inflation is slowing. Now, inflation can still be high, but if it declines, that's a slowing rate of inflation, and that's good for the market. What we're doing in the portfolios, number one, is we're still maintaining some cash, quite a bit of cash actually, higher than normal. We're using buffered ETFs, and if you've heard me talk about those, they're actually exchange-traded funds that track the S&P 500, but have a downside buffer. So perhaps the first 10% or 25% of loss, we don't lose any money. What we're giving up in return is unlimited upside. We do have a limit to the upside, but it does protect the downside, and those have worked extremely well. Next week, I hope to do a video explaining those in a little more detail with some charts and graphs and so on. Forgive me, I haven't figured out how to do that yet, but we should be able to do it next week. So I'll talk about that. We also have a position in the US dollar, which has helped, and we've seen some real improvement in the price of bonds over the last week. One of the reasons for that is that the bond market is also forward-looking, and they know that the Federal Reserve hiking into a recession can possibly cause the Fed to have to pull back on that. In fact, reducing interest rates later in the bond market is giving us some indication of that. So, what do we expect for the year going forward from here? Probably the third quarter is not going to be as bad as the first and second. There's been an awful lot of selling, big declines. Bitcoin blew up, and you may or may not have any Bitcoin, but a lot of people do, and they got hurt pretty bad. So what do they have to do? They have to sell their stocks to raise cash. So that's a couple of the things that that we have to look forward to. That Bitcoin stabilizing, oil prices coming down, inflation rate coming down, and we also have earnings coming up. So there's a lot to look forward to. It could get a little worse. I expect that we'll have a decent amount of volatility. With the volatility also presents opportunities. And we're here, we have a lot of cash in the portfolios, and we're looking for opportunities to make some money. One of the surprising areas that's starting to emerge is, as far as relative performance being better than the U.S., is some foreign investing, especially China. I know investing in China is probably not at the top of people's lists, but as a fiduciary, we're supposed to do what's best for our clients. And so we're taking a look at that. Chances are we're not going to invest in China, but we may invest in the Asian region around that to take advantage of their recovery. Keep in mind that they were absolutely locked down for over a year in China. And what happened to our markets once the economy opened back up, it just boomed. We expect the same thing from China. There may be many reasons not to invest in it politically, but as far as just making money, China looks good. So that's one of the things we're always looking for opportunities. We're looking for ways to protect the portfolio by using cash, buffered ETFs, and so on. So we're there. We're also here if you want to talk. We're always happy. Keep in mind that we work for you. That's important to remember. We work for you. You're our employer, and we take that very seriously. So if you have any questions, comments, please just feel free to pick up the phone, give us a call, shoot us an email, whatever you want to do. We're here to work for you. And if you do like the video, I'd sure like some feedback on it. What can we do better? Would you like some more charts and graphs? Less of me and a little more of my son or the dog, whatever you'd like to see in the videos. We want to be able to produce videos that are interesting to you. So thank you very much. Have a safe and happy 4th of July weekend. And I hope to see you all again soon.